Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at the global crypto ETF flows from James at CoinShares. We had a negative 721 million, mostly on the US side of the pond. If we look at the products, most of that was from Fidelity and Grayscale, most of it from BTC and ETH. Some inflows there for Solana, inflows on short Bitcoin, big outflows in the US, obviously, and in Canada. And as James is insinuating in the piece here, a lot of that has to do with, will it be a 25? Will it be a 50? And essentially boils down to if recession or not, if panic cuts or not, if hard landing or not. Looking at the 30-day cumulative flows from Bold Report, you can see here we haven't done much of anything on a 30-day basis recently. What I keep asking the market for, I pray to the market gods every night. I say, can we get consistent flows here? We really don't want spiking. This creates a lot of quick unrealized profits, a quick profit taking, overnight Lambos, that sort of thing. That's really not what we want. We want sustained, passive model portfolio type of inflows, because this kind of creates sour grapes, buyer remorse type deal when, let's say you bought February, well, early February, you're still doing fine, but late February into March, and you just get obliterated for 6 months waiting for something that's already happened effectively, right? Looking at the gold flows on the 30-day cumulative side, also fairly neutral. We zoom in a little bit over the past 2 years. Most of this breakout hasn't been retail on the gold side of things. As you may recall, this mega inverted head and shoulders on price that broke out. Even up here, there's a little bit of 30-day flows, not much. So even gold not seeing too big of an inflow on the retail side of things. Looking at the CME Bitcoin chart, we do have a pending bearish 5200 cross. The reason to look at this chart versus spot, this cuts off a lot of the weekend noise, a lot of the non-US trading hours volatility. We're below the cloud here, below the 200. We had a good mean reversion move today. We'll see if that can continue throughout the week. We should get a pretty good inflation number this week that may help us here, but this doesn't look particularly bullish. You know, I zoomed way out for last year. We didn't look as bearish as we do now, arguably, but we were bearish before moving higher. And a lot of this is just time-based capitulation. It just takes a while to squeeze the tourists out of the market, have everyone throw up their hands and say, okay, enough's enough. And then we start climbing again. Very similar move March to October in 2023. So on the CME chart, anything above 60, above 62 would be great. Avoiding the 5200 cross to the bear side would be great. Unless you're bearish, then you're probably sitting pretty, because that's where looks like we're mostly headed. Looking at the basis trade here in this panel from Velo data, CME basis has come down a little bit from 12 to 6 to 8. That's kind of bouncing around. This kind of shows you, in a sense, overbought, oversold if we go into backwardation versus forwardation, which is this current setup that may affect the ETF flows, that may affect the basis trade. Futures open interest came way down in dollar terms, in coin terms, and BTC terms. It's still at range lows. Volume still looks good. Options volume, to me, still looks good. On the ETH side of things, options volume kind of muted. Futures volume trailing off a little bit. ETH basis around 8%. ETH open interest in dollar terms way down because price is way down. And we really haven't seen a lot of uptake on the ETH side of things. One thing to keep in mind, as rates come down, they don't need to go to zero, but there's always this competition, this tug of war between cost of capital and risk. If cost of capital or interest paid on capital is high, it has a harder time justifying going into the risk market on the VC side of things, for example. On the altcoin side of things, for example, as rates come down, that conversation changes. That tug of war evens out a little bit. Let's say we go from 5.25 to 3.25. Then certain things from a risk perspective may become more attractive. And we're starting to see a little bit of early innings, potentially, of crypto VC fundraising. I don't know necessarily what this would be. I haven't seen, to me, what are projects that would be investable. And you can just see how frothy things got towards the end of the ZERP era. You know, this is just money looking for anything. And that's clearly not where we're at this current juncture, but it's definitely something to keep an eye on. You know, do we have VC froth here? Yes or no? Clearly no. Clearly VC froth 2021, 2022, absolutely seeing the raises we saw. Definitely not seeing those type of raises today. Before I go any further here, let me mention today's video sponsor and the exchange I use the most for crypto, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience for one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PBI, DBA, Kraken. And one other thing that not enough people talk about when it comes to Kraken is just the speed at which you can onboard and offboard capital. Sometimes for me, it's same day, which is wild. But it's nice to be able to have a trusted fiat rail that you can just go in and out of. And you can even send DeFi transactions directly from Arbitrum into or out of Kraken. So you can kind of live in all the worlds very seamlessly and very easily through Kraken. Yesterday, I mentioned this type of style of chart on a lot of altcoins, inverted head and shoulders attempts. It may be a little too early to trade this on the long side. We've had a bounce today. Again, will it last the rest of the week? But things are starting to look interesting a little bit, right? It's not just straight down anymore. For some of this stuff, we are ranging. There's a possibility of a neckline forming here, a diagonal neckline to watch into October. I wouldn't expect a breakout pre-October, even potentially into the election, right? Into November. But this is the type of thing where if you're a pattern trader, you're going to have the most success just watching this every day, spending 10 seconds or less, looking at the charts like this, saying, okay, what's the plan? What's the plan? What's the plan? And it really doesn't change, but you have a plan, it's solidified, and then you know when and where to take action on a chart that looks like this. You have a target in mind. Very obvious setup and plan. Certainly where I do the best trading, most profitable trading on my end. Looking at the calendar for the week, CPI and PPI, core, both of those as well, coming this week. Definitely the big kahunas of the week. And then next week we have FOMC, which would be Jay Powell talking at the podium, talking about why and how he's bringing rates down 25 or 50 basis points. Looking at the FedWatch tool, the market has fully priced in, it looks like, a 25 basis point cut. There's been so much jawboning about they shouldn't go 50, they shouldn't cut at all. If they go 50, it's a panic. And my justification is just calendar. They had no meeting last month. They're going to have no meeting next month. So what's wrong with the 50? There's political concerns, obviously. But looking at yields, looking at the bond market, those markets are pricing in deep cuts. Whether or not we'll get those cuts, I don't know. We'll see. But somewhere along this curve, on one of these meetings, we're likely to see a 50 instead of a 25, dependent on jobs and inflation. Inflation based on Truflation's metrics looks great. Directionally, it has been correct really since inception. They don't have all of the data here publicly, but at one point it was, I believe, as high as 15, 18%. And that's come way down, obviously. Now way below 2%. And we just continue to crush lows on real-time inflation. And you can see last month's was 2.9 on the reported CPI. This month should come in at around 2.56, 2.57. Core, I believe, will be down as well. And then next month's print for this month is set to come even lower. And that's what is in line with Truflation. It's not like there's some secret here. Occasionally you'll have some disconnect between Truflation and CPI. And this isn't what people are pissed about, right? This isn't why people are fed up with everything cost of living wise. This is why people are upset. It's the aggregate inflation since COVID that has just taken over everyone's life. You're losing a quarter of your purchasing power gone since COVID. That's the problem. The problem isn't the year-over-year inflation anymore. It's the aggregate inflation. Looking at some of the inputs for inflation, energy also seems to be pricing in global recession and or supply glut. It's not talked about enough, but the US is producing more oil than it ever has. And that is certainly helping bring prices lower here. Not a lot of people jawboning about the SPR now, but it's likely, I think, that the SPR would want to be a buyer sub 70. So that's something else to watch for. End of quarter, end of month does the SPR start to fill up or not? Trend metrics here are bearish, 5200 death cross below the weekly. Nothing here is bullish. This is potentially a mega head and shoulders. And it would be very, very interesting if we do have a global recession and it was most obvious and evident first on something like oil or commodities. Copper has gotten shellacked as well, iron ore, over the past couple weeks. National gas prices in the US continue to fall, continue to be closer in line with 2021 than 2022 or 2023. So on a year-over-year basis, you're going to see continuation in falling energy prices in regards to inflation. Across the pond in the UK, their inflation is a little more volatile. They've already started cutting rates, I believe. Their last report was 2.2 on inflation. That looks like it's going to rise. And even in the US, it's something to watch. You still have tons and tons of people talking about how inflation is just going to take off. It's going to go above 3%, 4%. That's possible, obviously. And that's where the Fed comes in, is threading that needle. But if you're ever curious, just go to this website and you'll see, right? We don't have to speculate whether or not inflation is rising because it's all right here real time. It's like 10 million data points, 30,000 sources or whatever. It's something ridiculous that they're aggregating all this stuff. And it's certainly one of the most sensitive measurements that I know of that's free and that you can view. So if you're ever worried about inflation, it's one place to look at it. Looking at the yield curve in the US week over week, this dark fuchsia, I guess, line below everything else for the rest of the year. I had to adjust the scale this week. That's how I know this is serious business. So like I said, the bond market pricing in significant cuts, continuous cuts, the belly of the curve, the long end, and the front end obviously controlled by the Fed, and that's going to come down likely next week. But this is why we've seen bond rallies across the board, the long end, the short end, the belly of the curve. All these charts continue to look great. This is exactly what you want to see on any chart you ever trade your entire life. A turn in the trend, a bullish breakout for the trend, or a reversal pattern, some sort of trend metric that's on your side. All this stuff looks great. Where this goes from here or can go from here is another question. We can always use measured moves. We can say we think it's going to go from 82 to 86 or whatever it is on the measured move. But collectively, all of these look very, very bullish and ready for a reversal, ready for bullish continuation after being beaten down for years and years and years. And if we compare the 2-year yield to the Fed funds rate in the red, you can just see the difference here, even in the futures estimation of where rates are going to be. Just a huge disparity here. So is this the bond market pricing in a recession or the expectation of a dramatic move in rates? And that's what it looks like. This was a head and shoulders, just as most of these charts are inverted head and shoulders, right? It's no coincidence that all this stuff looks the same and talks the same. So as rates fall, bond values are rising. One thing to keep in mind with all of these trades over the long term, again, we've been issuing debt in the United States on the front end significantly relative to the long end. Will we have to move that issuance from the short end to the long end when we're refinancing? Rates lower on the long end, we're locking in a lower rate eventually, hopefully on the long end. I think that's part of the goal here. And that has kept the rates artificially low. At least that's what this article is alleging, and it's certainly believable. So the long-term optimism of something like TLT may be tamped down just because the reality is the mechanics, the fundamentals of the issuance cannot allow this thing to get crushed on yield because we just have to issue and refinance so much debt. GDP still looks okay. Again, not recessionary, just isn't. It's not negative. It's not down year over year, quarter over quarter, whatever recession metric we want to talk about. We're not there yet. Doesn't mean we won't get there, but we're not there yet. But the bigger issue is debt to GDP, which is currently at 120%. So we are in debt way more than our GDP, and we can look at historically on a country basis. The question I had is, okay, when and where does this become a problem historically? Where is there a point of no return where you're issuing debt to pay for the interest on your debt? It's like getting another credit card to pay for the interest on the credit cards you already have. Eventually, as a human being, as a household, you get cut off from that. As a government, it takes some self-discipline and some people to take these deficits seriously to bring this back down. Globally, Japan, down here, 261% debt to GDP, Italy, and then the US. That's the order. And this is why people Bitcoin. This is why people like hard money, because they can avoid things like this. And what I thought was interesting, this chart goes to 2010, but debt to GDP now is above 2008. It's above the 70s. It's above the Great Depression. And world debt is very extreme. And that, to a lot of people, emboldens the use case of things like Bitcoin. Turning to the markets, turning to the S&P, now the bears are going to want me to tell you to come out here and say, there's a double top. It's over. This is going back to 4,600. And yeah, that's possible. I mean, last week we were talking about all-time highs. We'd never made a higher high. That idea got rejected, died on the vine. We never got the breakout to trigger the inverted head and shoulders. The cloud says this is clearly mixed. You know, we're back in the cloud. We're all over the place. We were a bit overbought coming into last week, coming into September. You always want to be on the right side of trend. You're going to see your biggest moves on the right side of trend when you get that signal. And here, it's not as straightforward. We could be setting up for all sorts of stuff, chart pattern wise, but none of that necessarily involves making a lower low, at least on the bullish side of the conversation. On the bearish side of the conversation, anything near 5,100 will be viewed as a double top. And then based on the depth of that, you're talking about 4,600 on the breakdown. Is that more likely here? Is that possible? Is it in the realm of expectations? Could be. But we need to see price get back down to 5,200, and we need to see continuation. We saw something similar, again, September into November last year, and that was it, right? So you can't just assume this is going to keep going, obviously. But if we make a higher high, then you measure from the other direction. 5,700 minus 5,600 is 600. 600 plus 5,600, 62,000. 6,200 would be the target, just based on the depth, right? Just as the target down here was the depth measured higher, the target up here is going to be the depth measured higher. So is this bullish? Is this bearish? It's kind of a bunch of nothing here yet for me. Trend just says neutral, nothing really else to discuss. Is there confidence in anything? I don't think so. When we look at things like equal weighted S&P, this to me looks more overbought, more kind of rising wedge territory. The cloud clearly telling you be careful. On the weekly with this TK disequilibrium, you can see what's tends to happen with structures like this in 2021. Very wide overbought conditions kind of just go sideways for a while, and eventually you typically see some sort of pullback. There's also a bear div here on RSP. So it's hard to say how much more we can expect out of the S&P in the near term until we see strength again. Looking at the Qs, again, the bears are going to want me to say, this looks awful, this looks terrible, this is going back to sub 400. What else do they want me to say? The cloud is bearish. It's certainly below the cloud. Again, cloud settings a bit mixed. This may just be a reaccumulation up here. And we'll have to see, right? What happens? Do we get back down to 420? Do we break 420? Or does this just triangle out? This is Costco, just as an example, where preceding 2022, Costco had a big move, slowed down for a year and a half, and then made a decision. But it didn't go from turbo bullish to turbo bearish in a day, right? These things typically take time, and we'll see how the market reacts, digests what Powell has to say, if Powell has any forward guidance on the 18th. We'll see what the CPI number does for the market here. But to me, again, this is just mixed. There's nothing really one way or the other here. It's obviously less bullish than it was above the cloud. It's less bullish than it's been. And we've discussed a lot of the Mag 7 that across the board, to me, none of them really looked good outside of Meta. This is positioning for the NASDAQ, and positioning that looks like this is very bearish. You want to be on the same side of commercials, which is the red bar there. You want to be on the opposite side of speculators, large and small. And when these are at the extremes, kind of like they are now, we usually don't see the expected move from speculators. So this is the opposite of long positioning that you'd want to see. Not all of these will lead to, in this case, a long squeeze. It certainly wasn't the case in 2024, at least the beginning of the year. The rollover, commercials got very short, large spec got very long, and we still had continuation there throughout the year until April. But it's just another sign things are looking overbought just based on positioning. Speculators a little too long, and to probably take it easy on the long side with the NASDAQ. Looking at one of the biggest components of the world, NVIDIA, this also, again, bears are going to say this is a double top. It's over. It's going back to sub 50. They're going to unsplit, reverse split, whatever. And look, that's possible. Sure, it's possible that this goes from 100 to 50. Is that likely at this point in time? Am I willing to bet on that direction and path? Not me personally. I like this above the diagonal resistance, similar to BTC, above the diagonal resistance on BTC. And on the short side, I'd rather just trade bonds, right? I'd rather just long this complex than fool around with being short equities. That just doesn't appeal to me. So my way to not trade NVIDIA or to trade NVIDIA on the short side would to be trading anything else. but yes, that is an option for you. The cloud is not bearish, bullish TK cross. Again, this is mixed. It's not yet fully bearish, but I wouldn't expect this to just magically pop back to 130. Now, if into Q4, we'll see if we are back above 110, into 115, into 120, then it's a different conversation. But this does not look bullish at face value here. And neither does Apple. Apple to me looks the worst out of everything. This looks to me like much more of an obvious potential double top. It's symmetrical, arguably, and that's definitely one to watch throughout the rest of the year. They just had their event today, and I just don't know how much of an appetite there really is for new phones or the AI phone. I don't know if people really care about that stuff. I certainly don't, but I'm also not everybody. Microsoft, we've been talking about this megaphone versus head and shoulders versus diamond top. This does not look bullish here. It just doesn't. And if the Mag 7 in aggregate doesn't look great, and that's most of the index, you just say, well, maybe I'm not long the index, right? Maybe I'm long other things, or I'm risk off in other ways. Measured move for this would be sub 350. Meta, to me, still looks the best, again, out of everything. Mag 7 still holding in there in that ascending triangle. It's a bit of a mess, and the trade doesn't trigger until you're at the breakout point above 543, but it still looks okay relative to Microsoft, NVIDIA, and Apple, and especially Google, which we talked about for a couple of weeks now, potential inverted cup and handle here after they got hit with some antitrust stuff. And this looks ready for bearish continuation, looks ready to break down. No question about it. And I think a lot of people are just generally looking at their Mag 7 exposure and thinking, yeah, it's been a long time that these names have done well outside of Tesla, and maybe it's time to reallocate to anything else. There was this inverted head and shoulders fractal on Tesla. It's still there, but I think this is less of a trade to pay attention to than this potential. If this can get back to 270, 265, then we can talk about a real trade. This is a real trade. This is kind of, you don't want to be on the wrong side of this, but you really don't want to miss if this breaks out to 265, which is saying something. But if it can break out from 265, that's something you don't want to miss, because that measured move is significant. You've also got this inverted Adam and Eve case, mega Adam Eve. Let's say, Utopia's here. We have robo-taxis, Trump is president or whatever, right? Whatever gets this going beyond 265, there's probably a narrative that we can construct to make that happen. I was poking around. I was looking at financials. XLF, much like equal weighted S&P, looks overbought to me, looks be careful up here, bear div territory. Doesn't mean it can't stay overbought for an extended period of time. Again, similar to 2021. RSI trending down, price trending up. But this isn't something I would want to jump in up here. TKC clamp as well. So that's why I just keep going back to these charts. This is where I want to be. I do not want to be in charts that look like this. JPM, very similar. Bear div, just getting a little long in the tooth up here. Probably well past its cup and handle measured move target. And I just don't want to stick around to find out. Goldman Sachs, very similar. Still kicking myself for missing this breakout here. But I'm assuming it's reached its measured move at this point. Probably some sort of double top on this. Definitely a massive TKC clamp here. And a bear div. So just a recipe for a void on the financials. Here's Morgan Stanley, a smaller name. Also has this head and shoulders on a high time frame at a previous neckline, a previous inverted head and shoulders. So there's a lot of this stuff that's just at equilibrium. It doesn't look attractive to me. And then lastly, the miners. The miners could also be a mega cup and handle. If this breaks down, we're talking about sub 10. I still see gobs and gobs and gobs of not the smartest of money type of people saying, yeah, I'm down a lot. I'm just going to keep holding. It's okay. So it wouldn't surprise me if miners break down here, regardless of what Bitcoin does. They certainly don't look ready at this juncture for bullish reversal, bullish continuation. If into October we get some sort of double bottom or triple bottom with resistance at 20, then we can talk about a breakout from 20 to 26 again. But here, these just all look like a massive avoid. So back to my favorite 4 charts right now, Legacy. These have looked good for many weeks. These continue to look good. This isn't a pitch for any of this stuff. It's just these are what I like trading. This is where I will like to live. So that's all for this one. Like, dislike, comment, share, subscribe, and happy trading.